Welcome to this thematic discussion brought to you by Livewire Markets. My name is Kidman, and today we're going to be discussing the hottest thing on the market. Your kids are buying them, your parents are buying them, even your grandparents are interested in buying them. We're of course talking about exchange traded funds, also known as ETFs. And to help to answer all of your burning questions, I'm joined by James Whelan from VFS Group and Adam Dawes from Shaw & Partners. Adam, I'll start with you.
Yes.
You're right in the thick of ETFs.
Yes.
What would you say is the most frequently asked question you get?
Most frequently asked question I get is, how do I buy and sell ETFs? Well, they come to a stockbroker to do that, but then also they ask about liquidity, and that's a big issue. How am I going to get in and how am I going to get out, basically?
James, you're also in the thick of it. What would you say is the most frequently asked question?
The most frequently asked question is the first few words of, is there an ETF that does X? Everyone sees an idea, has an idea, reads something, hears something, notices something, and they want to know if there's a way that they can package it. Is there a package that is readily available that they can go into the market and be able to buy and then sell as an investment? That's where the thematic stuff really comes in, and there's some amazing ones that are out there, but that's the most common question I get.
Well, you see ETFs every day. Could you pinpoint 3 things for us that you think every successful ETF has?
A main question that I have with a successful ETF is this smarter than me? And that for me is a successful ETF, because something is only as successful as it being better than what I charge people to do. So if you can find an ETF, that's for me the first and foremost one. If this ETF is an active ETF, for example, that is run by people who are better stock pickers than me, and I'm not a great stock picker, so that's not very difficult to do. But if that is the case, and that is the answer is yes, then that's a successful ETF.
Adam, what would you say the 3 key factors that you think every successful ETF has?
Yeah, so basically if you're looking at the index, so what do you actually want to get out of the ETF? And then looking at the index, does it actually match what it says on the box or on the package? So for example, if you're looking at a high active ETF and it's got an index worth a bond, it'll always beat that index. So you really should sort of lift the bonnet a little bit. I think managers are definitely key in that space. And then again, it comes down to the provider. Is the provider going to be around in the next 10 years? So we have seen a lot of cancellations of ETFs, so you've got to be careful who you're buying from and just lift the bonnet up a little bit on some of those ETFs.
A key concern that a lot of people have about ETFs regards liquidity. We spoke about it a little bit before.
Yeah.
So why is an ETF being liquid important? Is it important? And do you look for it when you're considering an ETF?
Absolutely. The reason is that we've all seen market falls and we've all seen these disaster areas, let's say COVID, global financial crisis, all of those kinds of things. The best thing about ETFs is that the market makers are in there. They actually only have to be in the market for 80% of the day. So there are periods when they're not in the market. And if you don't have the market makers in there, they're not going to be able to provide the liquidity to go in there and step into. Now, also the other side of it is if I want to get out, I might not be able to get out at the price I want, but I will be able to get out of it. And sometimes when you've been stuck in a stock or something where there's no liquidity, you could be sitting there for months. With an ETF, with a market maker in there, that liquidity is really important, and at least I'm going to be able to get out on the day for that client.
Quick tip, don't muck around with ETFs in the first half hour of the day. I can't stress that enough. You were mentioning liquidity. Yeah. That first half hour, anything could happen. People at home, mums, dads, grandpas, kids, just don't touch it in the first half hour. Liquidity is just not there.
Or why buy an ETF that's IVV, right? That's the US S&P 500 at 10 a.m. on the Australian market when the futures market, even the American market's not even open. Wait till 2 o'clock in the afternoon when the futures market is open in the US, and then you get a better price.
Take some of the risk off the table from time.
I'd be getting your pens and papers out here. James, what would you think, when the market crashes, you want to get out, obviously.
When the market crashes, take it easy.
So if the market crashes, you want to get out.
Yeah.
Is liquidity important for an ETF?
Oh, for sure and certain it is. It's funny, and as Adam was saying, that single stock liquidity will just dry up, and it's amazing what happened. Look what happened in March 2020, when physically people couldn't trade, couldn't muck around, couldn't do anything. There was absolutely no spread that was going on in anything like that. Be aware that can happen in anything that you're playing with. With ETFs, there's a little bit more assurance that actually there's going to be someone on the other side when you need to liquidate. If you need to liquidate, you don't need to liquidate.
Sure. Well, I love ETFs as much as the next person, but something I really struggle with is differentiating between providers, especially with something like an index fund. You've got iShares that offers an ASX 200, you've got Beta Shares, you've got Vanguard. So how do you differentiate between all these providers that are offering very similar products?
For me, it's really accessibility and the information that I can get from them. Apart from the obvious ones like size, reputation, reputability, how much backing you've got behind you. That's all a given as far as I'm concerned. That should just be a part of it. For me, it's accessibility. If I want to know something about an ETF, I want to be able to pick up the phone to the guy, to the girl who's there, and have them know what they're talking about. James, I've got some great ideas for you. You're looking for this sort of information. Here's some information. We'll be able to walk you through it. That's exactly what people pay me to do, and that's what I expect from my provider.
Adam, same question to you.
Yeah, MER, I think, management expense ratio. If you've got all these providers and it's a passive ETF and it's the ASX 200, why would I be paying 20 basis points when I can pay 7 basis points? Really, so that, and we know fees are a detractor from performance, so you really should look at that MER, take an understanding of what's going in and sitting underneath it, and potentially if it's lining up against 3 different index ETFs, check the one that's got the lowest MER, and that would be one of my choices for that.
Okay, well now we know what an ETF is. Maybe can you explain to me the difference between an active and a passive ETF and why that's important when you're considering one? Well,
we just talked about rockstar fund managers or people that can pick stocks better. Maybe not better than me, but anyway, no.
Better than not better than
a lot of other people. But look, certainly ETFs, so an active ETF is a manager that can take advantage of movements in the market. They can choose, they're only constrained by the index that they're playing in, and they can be overweight certain sectors, underweight certain sectors, and they basically can be active inside of that ETF. Whereas a passive ETF is just basically an index, let's say the ASX 200, and they have to use that, and they have to go within the weights of the banks, the resources, and it has to stay within line. So that's the passive, and you pay less for a passive and you pay more MER, again, for an active manager.
James, is there pros and cons of active versus passive?
It depends on the time that you're actually investing and what part of the cycle. For example, now, I want to be in something that's a bit more active because the market is a bit choppy, it's a bit volatile. There's a rotation potentially going on right now from, for example, growth to value. I want to be in an ETF with a manager that can pick that and be able to be ahead of it. An index hugger might just sort of go along. So it depends on what part of the cycle you're in.
Another question a lot of investors have is the difference between an active ETF, like what we've been talking about, and an LIC, so a listed investment company. Can you explain the difference between these two?
Put really simply, an ETF, when you buy that ETF on market, you're owning that fund, and then you're in effect owning all of the holdings that are underneath. With an LIC, I like that Adam is nodding his head. It means I'm getting it right.
Yep.
So with an LIC, you're buying that company, that investment company, and not the underlying. So it's a little bit different in that sort of way. If you like a manager, you'd buy that LIC because you can see their underlying. But if the ETF is more in a theme that you're sort of moving in, then you'd look towards that ETF.
ETFs, LICs, lots of abbreviations.
Yeah.
What would you pinpoint as the main differences between these two?
Well, really, there's a market maker. And in an ETF, there's a market maker which is hugging what is called the NAV, or the net asset value. With a LIC, there's no market maker in there, and hence LICs can trade above their NAV or below. So sometimes you might, not looking as an inexperienced investor, might buy above the net asset value, and then obviously it starts to come back, or you can see some discounts in there. So the market maker in an ETF makes sure that it sits around that NAV most of the time, and that's what I like. I don't want to be paying overs, or I don't want to be paying unders. I want to make sure that I'm getting the right price for my clients.
Okay, well, I'll throw another one in there, MER, management expense ratio. So that's obviously fees. How, number one, does an investor pay an MER on an ETF? And also, is that an important consideration?
Yeah, look, definitely an important consideration. We talked about that before, being that sort of trying to find, I guess, the cheaper ones in an index or a passive ETF. I think that's fair. With the active ones, you're probably paying a little bit more fee, MER, so that's, I think, is fair as well. I always thought that the MER was inside of the spread in the ETF, and when I was doing my homework for this show, I actually found out that it wasn't. It was not inside the spread, because that's where the market maker is. It's actually in the management fee that's inside the fund, and they will minus it, the management fee, let's say it's 10 basis points off the fund on a daily basis, and it's also done on a prorated basis as well. So if you're only in the fund for the last 1 month of the 12 months, you only pay 1/12 of the fee. So it's actually been quite well set up for investors.
MER, important, not important?
Yeah, it's pretty important. How much you're actually going to pay. And for an investor, take it into consideration with what it is that you're doing. If you've got to pay the brokerage, or if you've got to pay a service fee that you have to, imagine also that you need to pay this one on top. which is deducted. I always thought monthly, but there you go. Anyway, it's calculated daily, deducted monthly off the ETF, and that just comes straight off the price of the ETF that's there. And that's something that you need to sort of take into consideration too, is what you're going to have. If you like a really good active manager, that's good, but be okay paying up for it. So, but just take it into your overall cost.
There's only one ETF that I've seen where PM Gold, they actually take units off clients at the end of the year for their fee. So we've had these unhappy clients that had 1,000 of these ETF shares, and then all of a sudden they've got 990, and they're sitting there going, "What's going on?" And then we had to go through the PDS and actually look at it, and that's how they take their fee at the end of the year.
Is it because it's physical gold?
Yeah.
Yeah.
So you got to be careful when you buy.
Fair enough. Well, James, there's been a lot of crazy activity in the market. We've seen GameStop surge, we've seen Bitcoin rise, and ETFs are really looking to take advantage of this. We've seen the Buzz ETF, we've seen the FOMO ETF. So what would you say are some of the risks when getting involved with thematics like this?
I've got this sort of little idea that's in my head, which is that you've got a buzz, you've got a theme, you've got some sort of a fad. And if you can ride that, usually by the time you hear it, you're going to be the last to know, and you might just be the last money, the last bag holder left of the day. When a fad becomes an actual theme is, in my belief, when a government gets behind it. The example that I would say, probably Bitcoin might be one of the most recent examples, but let's just say medicinal marijuana, so your cannabis stocks, that went from being a fad, everyone's going to be doing these amazing things, to all of a sudden the US government says, we're going to start legislating and taxing it. Great, that's not a fad anymore, that's now a theme. That's now an actual investable idea. That's when that changes. So if you want to be in a theme, just try and make sure the government's behind it before you really charge in.
Who would have thought we'd ever be investing in FOMO? What are some of the risks that you would tell investors to be wary of when investing in these sort of themes?
Look, there's certainly themes, and the FOMO theme, the Buzz theme, and all these kinds of things are certainly themes. And I think that's the issue with this, is that a lot of ETF providers actually take time to get these products onto the shelf and out to the market. And sometimes that's 6 months. And potentially that could be a little bit too late. So potentially you might be holding the bag on something that potentially, like the marijuana sector, certainly everyone got excited, but then it all fell away as well. So I'd just be really cautious about the buzz words or the buzz ETFs that are out there, because potentially they won't last as long as you expect.
Well, what are you waiting for? It's time to jump into the ETF investment universe before you get FOMO. If you've enjoyed this episode of Buy, Hold, Sell, make sure you subscribe to Livewire's YouTube channel for more.